Hello and welcome to this session. This is Professor Farhat, in which we will discuss communication of control deficiencies. In the prior session, we looked at what are the control deficiencies, and we looked at the three types of control deficiencies: control deficiency, material weakness, significant deficiency. In this session, we will discuss how to communicate this information. To who? To people who are in charge of the governance. Auditor must clearly and on a timely fashion communicate significant deficiencies and material weakness identified during the audit. When? As it's early possible during the audit if there's any significant deficiency or material weakness. And why? We want to make sure that management and those who are in charge can take appropriate action. If there is a problem, if there's some sort of an issue with internal control, let them know as soon as it's practically possible. Now, when auditors discuss identified deficiencies with management, they want to make sure whoever gets this information has enough authority and understand the area that we are dealing with. So if you are dealing with accounts receivable, you want to get it to someone who knows about accounts receivable and who has the authority to make the changes. And direct discussion with management may not be appropriate. Hold on a second, why not? If the identified deficiency involved doubt about management integrity or incompetence. Why would you tell them that you don't trust their integrity or they're not competent? So if the problem involved management, you want to do what? Go a level above management, maybe the audit committee, maybe the board of directors. Hold on a second, how about if the audit committee or the board of directors lacks integrity? Run away, don't get involved, right? But that's the point. The point is, if you are involved and you have an integrity problem, you don't discuss it with them in a sense that you want to fix it, you want to go a level above. For example, an auditor finds a significant deficiency involving the approval process for a vendor payment. Okay, if that's the process, normally we will discuss this with management or the financial controller, people who are responsible for this process. It's very simple. Problem with the approval process, you need approval before you make a purchase. Who's in charge of this? Let them know. However, if the auditor believes management is intentionally bypassing the controls, then if you talk to them, it's not something that they're overlooking. They are intentionally doing so. There is an intention. There might be a fraud situation going on. Then we would communicate directly with the audit committee instead. Now we would look now at the details of the communication. For example, what do we need to communicate, when, so on and so forth. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
First thing we'll discuss four things. First is previously existing deficiencies. If significant deficiencies or material weakness identified in the prior audit were not corrected, we must communicate them again in the current audit. We're going to see an exception. For that. They can do so by referencing the previous written communication and its date. So last year, the auditor noted that inventory reconciliation were not timely. It was a significant or a material weakness. If this issue has not been resolved, the auditor must repeat this concern and reference the previous communication. Unless you're going to see later, I'm going to tell you lie. I'm going to tell you why. Unless they believe, in other words, the company communicated that it may not be a cost benefit to do so. They're aware of it and they have a reason for that, for not letting it go. They did not correct it. When do we have to communicate this information? Well, ideally, auditor should communicate deficiencies in writing by the audit report release date. So you have up to 60 days after the report release date to formally issue the written communication. However, auditor can also communicate deficiencies earlier, either verbally or in writing, but they must eventually document the communication formally. So one more time, if the question is if there is an issue, when do you have to deal with it? As soon as possible. Let them know, whether verbally or in written. Remember, but by the release date, but you have up to 60 days after the report release date to formally issue the written communication. But you want to let them know as soon as possible, as soon as possible. An audit is completed on June 15th and the audit report is issued 15 days later, June 30th. Auditor must formally document and communicate any significant deficiencies or material weakness by August 29th, which is 60 days after June 30th. Now again, if there's any difficulties, any issues with the internal control, you could immediately let them know. You don't have to wait, but you should let them know immediately. But formally, you have 60 days after the report date. Management evaluation and responsibility. It's management responsibility to assess internal control deficiencies and decide how to address them. So management may choose not to correct some deficiencies based on cost-benefit consideration. Well, if they tell you, look, we're not going to correct it due to cost-benefit communication. Yeah, we are still obligated to communicate these deficiencies in writing, but we don't have to repeat it the following year if that's the case, because we already know that they said it's cost-benefit consideration. So management decides not to implement expensive control improvement related to payroll processing because the cost outweigh the benefit perceived. We would still document and report these deficiencies, but we don't have to repeat it for next year. Communication of other deficiencies. Less severe deficiencies, other deficiencies that do not reach the threshold of significant or material weakness, those are communicated to management directly, and that's all what you need, because they are less severe and you need to let management know about them so they can correct them. There's no need to go to higher level. Significant and material weakness, you're going to see you have to go at a higher level. And this communication can be oral and in writing. You always at the end put it in writing. If your communication is made orally, you should document the discussion that took place. Now, when it comes to form of communication, how do we communicate this information? You have to know the difference between a control deficiency, which is a less severe one or a minor one, versus a significant deficiency versus a material weakness. The form of communication, if it's a control deficiency, a minor one, communicate it to management only, and orally or in written, always document the discussion as well. That's fine. If the issue is significant deficiency, and we talk about significant deficiency, communicate to management in writing, communicate to those charged with governance in writing, and you have to do it 60 days after the report date. You have up to that. It doesn't mean you wait. You can communicate it as soon as possible. Material weakness, same thing. Communicate with management, those with charged with governance, and you have up to 60 days. Few other consideration to repeat. As I told you, you don't have to repeat a deficiency from the previous if management have decided not to correct them based on a cost-benefit relationship, unless you think situation significantly changes or the auditor believe recommunication is essential. You have to know about this exception. Sometimes they give it to you on the exam. If deficiencies have been communicated by others like internal control or regulator, you don't need to repeat the communication. And auditor may share details about other deficiencies like the audit committee if the committee requests or the auditor believes governance should be involved. That's fine. You will do that as well. You would share detail with them. Now, let's talk about the form of communication, which is written communication. What are the essential components when you give them this information? So when the auditor formally communicate those deficiencies, those significant and material weakness, certain key elements must be included. The first thing is the definition of terms. So we know what we're talking about. You clearly define material weakness when relevant, as well as significant deficiency. And we talk about those in the prior session. Description and explanation of the deficiency. Provide a clear description of each deficiency or material weakness identified. Explain the potential effect of these deficiencies on the financial statements. We have a deficiency and this is what could happen. Auditors are not required to quantify the exact financial impact. You don't have to tell them, the loss will be an X dollar amount, but something could happen. That's all what you have to do. Instead, the auditor can describe the effect in terms of the errors or risks the control was supposed to prevent, detect, or correct. But you don't have to give them a dollar amount, because if you give them a dollar amount, they might say, well, you gave us this dollar amount, we don't think it's worth it. How would you know what the dollar amount would be? Because accounting, everything is interrelated. For example, the absence of a formal authorization control for payroll increased the risk of unauthorized or incorrect salary payment. We don't know how much it's going to be. We don't want to risk our neck and put a number out there, right? Also, in the report, you have to provide enough context for those charged with governance to understand the finding. And what should you explicitly state? Well, or clarify. The purpose of the audit was to express an opinion on the financial statement only. If that's the case, you just have to let them know that this is not an internal control engagement, and you happen to find this. So this is for financial statement only. The auditor did not provide an opinion on the effectiveness of internal control. If you're not engaged to do so, you tell them, I'm not. The auditor considered internal control to design the appropriate audit procedure, but not to express an internal control. So if you're not auditing my internal control, why did you get involved with this? Well, I need to understand the control. I need to consider it in order to perform my financial statement audit. And as a result, I found those weaknesses. The auditor did not necessarily identify all the deficiencies. Of course, we cannot give assurance. Additional deficiencies could exist beyond those communicated. You have to let them know. And you have to restrict the communication, include a statement restricting the distribution to who? Usually management, people in charge. Clearly specify that it's not intended for wider use. And under certain circumstances, when applicable, you have to include additional points like inherent limitation of the internal control, explaining that even a perfect internal control cannot guarantee the prevention. Specify the nature, extent, and control consideration, detailing how thoroughly the auditor considered internal control. Did I do sampling? Did I look at everything? Did I look at only certain area? Reasons for not reporting absence of deficiencies, stating explicitly that the auditor may not provide assurance regarding the absence. We cannot tell them we didn't find anything. Why? Because the limited scope of the control testing. We didn't look at everything. Even if we look at everything, we still cannot provide this assurance because we can miss something. Also, statement that of no material weakness. Auditor may explicitly state that no material weakness were found during the audit, especially if required by governmental authorities. If that's the case, that's different. What should be the management response? Management can provide a written response explaining the action they have taken or plan to take the correct to identify a deficiency. They have to do that. When management believes the cost to address those deficiencies outweigh the benefit, then if corrective actions are not planned, we have to let us know. Otherwise, if you have to take any corrective actions, please let us know if you already took or if you are planning to do so. So if management response is included in the auditor's communication, auditor should state that management response were not audited and therefore not verified by the auditor. So we have to let them know too that they responded and they are included in our report, but we did not verify this information. Let's talk about additional required communication when you are auditing an ERISA plan. When auditing financial statement for ERISA, which is the Employee Retirement Income Security Act, auditor must communicate certain additional information related to the compliance finding. In other words, is this ERISA plan is in compliance? You have to describe any reportable finding related to the plan. What could be a reportable finding? When you have those retirement plan, they might have certain rules. One of the rules is you can only invest in AAA and AA bonds or securities. And let's assume you find out they have a single A or BBB bonds or investment graded securities. Well, they are not in compliance with what they are claiming. Under those circumstances, you can report these findings. You have to give contextual details for understanding the communication by management and governance, and you have to show the potential impact of these findings on the financial statement plan. So you have to give them details about this. Basically, you would consider it a violation, not in compliance. Now, the auditor should not issue a communication saying that no reportable finding exists because you cannot give this assurance. But if it exists, you have to report this. So if the auditor discovers that a retirement plan failed to make required contribution, which is part of the compliance, we must describe this clearly and discuss the potential impact on the plan financial statements. Now, obviously, the retirees would definitely call up and complain, but this is a violation of the plan. Let's take a look at this multiple choice question from Farhat Lectures. An auditor encounters significant difficulties during an audit that are likely to lead to a modified opinion. Now we have some serious issues that those issues could lead to modified opinion. When would it be most appropriate for the auditor to communicate these difficulties? So if the issues somehow would lead to either qualified opinion or worse, adverse, when do you think we will need to communicate these issues to, those difficulties? Do we wait on the report issue date? Too late, right? Early in the audit engagement acceptance process. Hold on a second. The word early early, but hold on a second. Engagement accepting process, you didn't do anything yet. You're just accepting the engagement. This is worded to confuse you. As soon as it's practical during the course of the engagement, absolutely. You want to let them know. Why? Because we want to correct this. On the last day of the field work, too late as well. What should you do now? You want to go to Farhat Lectures, look at additional lectures, multiple choice, AI CPA questions. That's going to help you. If you're studying for your CPA exam, invest in yourself. That's the best investment you can make.